please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Bazaar Morning Call. I'm Lata, with me are Anuj and Sonia. First, let's put all the facts on the table. It's a somber Friday and here's what happened overnight. The Trump administration unveiled tariffs designed to punish China for intellectual property theft, imposing about $60 billion in import tariffs. China, the world's second largest economy, responded, proposing sanctions on 128 US products, which had an import value of $3 billion in 2017. US markets have fallen sharply, pressured by worries of a potential trade war and a decline in tech shares. Dow Jones Industrial Average has dropped 700 points. This 2.9% decline, the worst since the 8th of February.
And in safe haven buying, the 10-year Treasury yield has posted its biggest one-day drop since September of last year as investors bid up bond prices, while gold futures have gained about 0.5%. This morning, Asian markets have been taking it on the chin. The dollar has extended losses against the safe haven yen as well. The yen has touched a 16-month high earlier, and the SGX Nifty, most importantly, is indicating a 100-point cut just at the start.
All right, so those are the facts of the case. Let me just put a counterpoint. If you counted all the tariffs, it comes to about $50 billion of trade affected in China itself. Now, this is versus a $375 billion trade deficit that China runs with the US. The immediate numbers that we are getting are from Morgan Stanley. The impact on Chinese trade is going to be between 0.7 and 0.9 percentage points. So what are we talking about? Not big numbers. And the GDP impact could be about 12 basis points. So if it was 6.5% Chinese GDP, it could become 6.4% Chinese GDP. Big, but not earth-shattering. The Chinese retaliation is only $3 billion. Yes. So the point is, this is a synchronous global growth story. It's not affected if the US yields are falling, factoring in lower growth. It is more on fear that this will escalate out of control. Yes. At the moment, there is not danger to growth. That's the point I want to make.
Even a lot of the economists who have written their reports indicate that, one, of course, it's not as bad as what the fear was earlier. And two, there's a possibility of it getting ring-fenced, some compromise coming in from China. Of course, we are not global experts, but this is the opinion on the ground. Having put that on board, the SGX Nifty is indicating that we could be headed for quite a weak start. Anuj, morning. This has been a firm sell on rally markets, and today we'll open with a gap down. But how do you really trade that? Is it too late to sort of take a fresh short call, or do you think that, through the course of the day, because we're ahead of the weekend as well, you don't know what happens with the US markets later tonight, shorting could be the way to go?
Morning, Sonia. I think I'll answer the first question first. Perhaps you don't trade for start. After the event and after the big decline and with the market so close to support, the short trade was on at 10,600 and the market had given you enough indication that this was a tradable correction. We spoke about it yesterday as well, that this was a tradable correction and you should have traded it. For now, of course, the force of global cues is just way too strong and you have to take it. We need to see if the 10,000 holds or not. Right now, the SGX Nifty is indicating we'll start there at around 10,000 mark. If the significance of 10,000 is important. Otherwise, the way the rest of the Asia is falling, Hang Seng, etc., we would have also been down about 2%, I think, in SGX Nifty. But because 10,000 is an important mark, I think the bulls would want to defend that once. But the head and shoulder pattern that we've been talking about it's obvious that 9,700 now is a distinct possibility for this market. Perhaps not in one line, but at some point it should happen. We are also now in expiry week technically because expiry is on Wednesday. So the momentum is with the bears. The Indian markets have given enough indication the way the market sells off in last hour of trade, and last hour of trade is the most important hour of trade. Simple as that, because that's the hour in which the real professionals and the smart money is really at work, and that's been giving an indication for many days now that there's a problem with this market falling from 200-day moving average. The only point is that this is a market which is now net short and hugely net short. FI exposure is down to 41%. And portfolios, by the way, are already representing what the Nifty would be at 9,700, 9,800 because of the distribution that you have seen in the mid caps. To cut a long story short, for today, I think best would be to observe the first hour low. If first hour low is being broken, in that case, perhaps you are in for a trend day. And the better trade would be if there's any recovery if there's recovery, in that case selling would come back. Then perhaps you could look at shorting. But the last hour I think is really going to be crucial today, because that would tell you whether we are now reaching a stage where things are bottoming out. That's something from investment point of view that's important, because we are not at 11,000 anymore. We are at 10,000. So the bad news is hitting us at 10,000, not at 11,000. And there's just one point which I think the market picked up yesterday as well. Yesterday's last hour selling was on account of IT stocks. Yesterday the IT stocks actually underperformed. So is the market now fearing that this whole trade war, what is our global angle to trade war? It's the IT. And that's been one safe haven. That's been the leader for this market. If IT starts to, give up the gains, in that case, you're looking at a bit of a problem. So let's see how the market responds. The first hour, I think, becomes crucial.
Okay. Now, I just want to put the counter view. It may not be the necessarily a possible scenario. The Indian markets had genuine problems. The economy has genuine problems. There is a problem with the banking sector. 70% of the banking sector is not in a position to lend and will not be in a position for the rest of the year. Added to that was the worry of political instability, rightly or wrongly. It is hanging like a cloud. The only Trump we had on our hands was literally Trump. That the global markets are so good. There is such a good synchronous global growth that we cannot fall so much, because you'll be part of the global story. Now that Trump card is not working for us. So I would be a little worried. We were already creaking under our own weight of expectations not being realized, of 2018 being genuinely a tough year for the economy in terms of finding money, the cost of capital. And with this global positivity now slipping a bit, albeit. Actually, I would worry about Indian markets.
And nobody knows, even the best economist doesn't know which way this could head, right? What the retaliation could be from China, etc. So, well, everything is up in the air at the moment. But what we can do for you is tell you what wise experts have to say as we head into trade this morning, and how you should perhaps wade through all of this bad news. Chris Wood of CLSA Greed and Fear says the stance on trade, if pursued by the Trump administration, can clearly make more waves in the financial market. He says the most likely outcome in Greed and Fear's view is that China will agree to some form of compromise and will stop an escalation into an outright trade war. Indeed, he adds, there are already signs of this, as China has already responded this week to the Trump administration's threat of a Section 301 investigation targeting the intellectual property rights issue. Chris adds Beijing will remain very unlikely to play hardball in terms of threatening to sell treasury bonds and the like. He says while net exports are nothing like as important to the Chinese economy as they used to be in terms of driving real GDP growth, the export sector still employs a lot of people. He says Trump will also probably be satisfied personally if he can demonstrate that he has delivered a better deal with China. Okay. That's interesting.
Yes, more reactions coming. This one from Morgan Stanley, reacting to the trade war announcement. Chetana here of Morgan Stanley says the impact of US imposing tariffs of $50 to $60 billion of goods imported from China is largely in line with the scenario of, let me quote, targeted use of Section 301. These measures are expected to have a relatively moderate impact and could weigh down export growth by 0.7 to 0.9 percentage points, translating into a drag of 12 to 14 basis points on GDP growth after considering the spillover effects. He also believes the response from China will likely remain pragmatic.
Okay, he also believes that the trade measures by the US are less aggressive than initially feared, as it had been announced that the EU, Argentina, Australia, Brazil and Korea are now exempted from the steel and aluminum tariffs. This decision to exempt more countries has reduced the impact on trade partners, and the risk of proportionate countermeasures from trade partners has also reduced. So I guess the sum and substance is that it's not as bad as what the street was fearing.
And at least the reaction now looks a little exaggerated, but let's see. Money market views. Bhaskar Pranda of HDFC Bank says USD-INR pair will continue to be under pressure due to the month-end, year-end demand for dollars, actually. He expects the USD-INR to trade in a range of 65.10 to 65.30.
Okay, Bhaskar Panda also expects the 10-year benchmark bond yield to trade in a range of 7.53 to 7.58% today.
Okay, we have Richard Harris joining us, Sean Rain and Zahangir Aziz as well. It's going to be a big day, of course, for global markets. We've already seen that play out. Gentlemen, good morning. Richard, let me start with you. Is the equity market overreacting, or you think this is a sign of things to come?
No, I think the equity market's probably doing what the equity market should be doing. It's pricing in a bit of bad news that it should. And in a way, this is new news. You know, it's taken the Trump administration about a week to get into its maybe slightly thick head that it's no point if you're looking at doing punitive sanctions on people who may be abusing the system, to actually put sanctions on items that are going to affect your friends. This really turns it on its head and directs the sanctions trade tariffs towards China. So it's very much directed. It's very much in the way that the administration wanted to do at the beginning. But also it does open a whole new can of worms, and the markets are reacting to the uncertainties about that.
Yes, of course. The fear of spiraling out of control. Jahangir, good evening to you. At the moment, the damage is limited, isn't it? There is a Morgan Stanley number saying that it's about 0.1%, 10 basis points of Chinese GDP. And China's retaliation also is only for $3 billion of US imports. Relatively proportional and modest reaction?
Look, I think there are two parts to what the USTR report. And I think we are focusing way too much on the first part and ignoring the second part. So the first part is the tariff part, and even there, it isn't clear whether the $50 billion that everyone is talking about is the tariff base or is the total amount of tariff. Now, they are going to reveal the list of items, which is going to run into thousands, on which they will impose the 25% the tariff. Now, we, like everyone else, are assuming that the base of that tariff, i.e. the value of all those 1,000-odd items, is going to be $50 billion. You put 25% on that $50 billion, and that is not a very large amount, and the growth impact on China is about 0.1, 0.12, and with, of course, there will be spillover effects on North Asia, Korea, Taiwan, Singapore, and Vietnam, which are all connected to this particular group of goods and services that China produces. But we do not have clarity on those items. We'll have to wait and see what that 1,000-odd items are, and then see whether that actually adds up to just $50 billion, or is it going to be more? So that's the first part to it. And I think there's a second part to it. And I think this is the part that will have much larger impact depending upon how it is actually implemented. And that has to do with international intellectual property rights. It has to do with the fact of, as USTR calls it, unfair licensing restrictions. It has to do with the overseas investments that the Chinese corporations have done, and they will put out what are the measures against that. Those measures are very difficult to quantify unless you actually see them. So my sense is that, like everyone else, at this point in time, at our first reaction, yes, it is only going to be on the $50 billion of tariff base, and the impact is going to be modest. But we will actually have to wait and see what those numbers, what those exact lists of 1,000-odd items are, and what the IP and the non-tariff related measures are going to be.
Sure. That's a very important point you've made, Jahangir, that if it is a $50 billion on just the tariff base, then it could be a moderate impact. But let's get Sean Rain. Sean, you've watched the Chinese markets and tracked it for a very long time. I know it's hard to guess, but do you get a sense that China could agree on a compromise? And if they do, then, it could stop an outright trade war?
Look, President Trump is right to criticize China for unfair trade practices. However, he's wrong on what he's targeting. The tariffs on imports from China are sort of mistaken, right? A lot of American companies like Apple account for $18 billion of that trade deficit. So I view this, though, as a smart way for Trump to push and scream and use bluster. It's sort of his well-worn negotiating tactic to get the Chinese to compromise, and I think they will. I think the reality is they're going to open up the markets a little bit more for American companies, which is really what needs to be done. So they're going to allow financial service companies to be able to issue more credit cards, do more private wealth management. They might allow more electric new energy vehicles to open up factories that are wholly owned in China. So I think what's going to happen is China basically is going to dangle some economic carrots out to Trump, and Trump is going to eat them. And he's going to be able to go back to his base in the United States and say, see, I gained these concessions from China. I think the fear of a full-blown trade war is way over-exaggerated right now. I actually think both sides are going to be fairly pragmatic.
Okay, that's an interesting one. So Richard, for emerging markets, do you think this is actually presenting an opportunity? Last year, of course, was a big one. Do you think this is actually presenting a buying opportunity for investors?
Well, I completely agree with your last speaker. In fact, a little earlier I called it Trump trade trash talk, which is difficult to say if you haven't got all your teeth. But the point is that there is a lot of trash talk going on. The values involved are quite small. You're looking at something like, at most 2.5% of total imports into the U.S. But it is very directed. And Trump will have a lot to boast about if it works. Now, what I think is that we're likely to see China resist this quite substantially. Because China's not going to be pushed around. They're just not going to do it. However, what you may well see that when the dust settles, you may well see a lot more reform, and a great deal of more reform needs to be done. But I agree with the last speaker. I think that what we're seeing is a dip, and the market's quite right to discount the bad news and come back. But my feeling is that if you just look at what Jay Powell was saying yesterday about the Goldilocks scenario in the U.S. economy, you still have to be bullish on equities. Maybe bullish or a bit lower down, but still bullish on equities.
All right. Okay, well, we'll just end this conversation by taking one comment from each of you on whether this is going to impact world growth or whether, this is a passing problem. First, you go, Jahangir. At the moment, with the information you have, do you think it's noise and it will pass, or do you think this is going to actually impact the volume of global growth?
I think it does have an impact on volume of global growth, even though it might be modest at this point in time, because once you start something like this, you put in a degree of uncertainty in global trade and therefore global investment that wasn't there before. And to the extent that you are now putting uncertainty about where things will be going, to that extent, global investment is going to be slower than what you expected before, and therefore it will necessarily have an impact on global trade. And for emerging markets, global trade is the lifeblood of emerging markets. So the impact on emerging markets will be larger than that on developed markets.
Absolutely. Sean, what about you? Even if China does... Okay, Sean's not with us. So, Richard, what is your own view? Even if China does have a pragmatic approach to this, do you think global growth is at risk this year?
I think global growth will be affected. There's no doubt about that. But I think it's just going to be lost in the rounding figures of a world that's already growing quite happily.
All right. That's good to hear if it will be lost in the rounding figures. Thank you very much, Richard and Jahangir. We'll try and get Sean again. But it looks like at the moment the impact on growth will be there, but it will be limited. The markets are, of course, penciling in much more than that. So perhaps we are going to see a one-day impact or a few days impact. That's, I think, the answer.
Yeah, but the texture of the market has been broken for sure. And the SGX Nifty, by the way, is now below 10,000 again. 9995 is what we have on the SGX Nifty. So there's a possibility of starting straight away below 10,000 mark on the Nifty. The Hang Seng is down 1,000 points now.
Oh yes, I guess we just need a reason to correct now, since we have another reason. So market could be under further pressure.
Only good point is it's Friday today. So.
Yeah. Okay, well, let's take a quick check on what's happening with commodities, right? Because there as well, there's been a big move seen in crude. Daniel Hines, the senior commodity strategist at ANZ Research, joins us now. Daniel, thanks so much for joining us. There's been global mayhem because of what's happening with the trade war, but we've also seen crude escalate to almost $70 a barrel on Brent. What's your own view on how things could move from here?
Yeah, it's certainly been quite a volatile period. I mean, early in the week we saw the unexpected drawdown in inventories, which I did think really changed the tune in the market. There've been obviously expectations of a fairly big build in the US. So this does obviously highlight the tightening. The sense of tightening in the global market with exports out of the US driving that decline in inventories, and that I think has certainly resulted in an underlying bid in the market. But clearly, the global trade conflict going on at the moment now is certainly providing a lot of volatility, and I think it's yet to obviously play out, but has some pretty wide ramifications for the oil market.
Okay. Well, so what is a range we should work with? 70 plus?
Well, I think the market certainly is in a position where it could certainly spike higher, particularly over a short period of time due to these declining inventories and the real possibility now of that geopolitical risk really causing some sort of supply side disruption. I mean, the issues around the trade conflicts certainly raises the risk of the US becoming even tougher, I suppose, on Iran, for example, and the renegotiation of that nuclear agreement. So that could obviously represent a shift in potential sanctions around its exports as well. So it's certainly conducive to a spike in prices at the moment.
Okay, Daniel, thanks a lot for stopping by and giving us your thoughts. So there are some geopolitical risks, further geopolitical risks, and that could spike prices.
No, I take your point, but the only counter to that would be that if you have question marks on global growth itself, and if risk appetite itself is going to lessen, that also puts a roof to how much crude can rise.
Oh, absolutely. We'll keep an eye out on all of that. But for now, let's get you some more market opinion on the other side of the break. The big story remains the global market. So many more guests will join us in just moments from now. Stay with us.